In today's episode of the MSA Rental Market Update, we are looking at the Northwest Arkansas rental market for conventional multifamily properties. So as you can see, the Northwest Arkansas metro statistical area is drawn out here by CoStar. And you can see that we have Memphis over here. And we've got Oklahoma City over here, Dallas down on the south side. Up to the northeast, we've got St. Louis, and we've got Wichita, Kansas, up to the northwest. So I'm going to scroll in. I don't normally do this, but I'm going to scroll in because this is really a tale of two areas. So you can see here that this area, this glob of apartments, is the Fayetteville, Arkansas area, home of the Hogs, the University of Arkansas. And then this clump of apartments up here, this is the Bentonville area, home of the headquarters for Walmart. So we kind of have a tale of two areas here, though they aren't very far apart from each other. If I remember right, they're only about 45 miles apart from each other. So I just wanted to give you a little idea of what we're looking at. So now let's go take a look at the filters and see what we are excluding. And as usual, we are excluding all corporate, all military, all senior, and all vacation. And we are only including market and market affordable. If we go to location, we can see that we are in market, metro statistical area, Northwest Arkansas. So let's go take a look at the analytics and see what the analytics have to say about the Northwest Arkansas metro statistical area. First, by looking at all three asset classes together, and then we'll look at each individual asset class, class A, B, and C individually. So here is our supply side snapshot for the Northwest Arkansas metro statistical area. You can see that there are 645 properties in this market, totaling 39,933 units. There is currently 2,523 units under construction, and 1,102 units have absorbed over the last 2 months. That means that 1,102 more units were occupied than went vacant. In the previous 12 months, 2,470 more units rented than went vacant during that time frame. We can see that we have a very low vacancy rate here. We've gone from 3.8% down to 4.5%. I'm going to go out on a limb here and say that these rents are probably sustaining in this market looking at this vacancy rate. Even if we show a slowdown or a slight decline, which I doubt we'll see, typically when you have vacancy under 5%, you're definitely raising rents because there's some demand built up in this market. We can see that year over year, and this is one of the largest year over year increases we've seen to date. We've done almost 45 properties at this point, or 45 markets. We've gone from 927 to 1,001 a month. Okay, now this is asking rent. This isn't effective rent. Of course, we look at effective rent. Okay, so we are not looking at the capital markets. We are only looking at the space market. If we scroll down, we can see that the long-term occupancy average is about 95% for this market, but we're sitting about 95.5%. So we are above the long-term occupancy average. So when we get to the end of this video, I will plot on the market cycle chart where I believe the Northwest Arkansas metro statistical area is located. But I think for a change in the Sun Belt, albeit on the very northern edge of the Sun Belt, it's probably going to be somewhere up here looking at our supply side snapshot. But let's go take a look at the data and see what the data is telling us for all three asset classes combined. So here's the rent analytic data for all three asset classes in the Northwest Arkansas metro statistical area. We do not look at asking rent. We don't care what the ownership is asking. We care what they are collecting. So we only look at effective rent. So if we look down, we started in the first quarter of 2022 at $928, went up to $979, up to $997, up to $1,000. I'm going to stop looking at January. I think January's given us erroneous data throughout all the markets we've looked at since we started looking at January, and the data has not followed demand supply principles where the other quarters have. So we're going to discount the 2023 data for right now. So right now we're only going to look at 2022's information. So what we're seeing here is an increase in rents, and this does not surprise me at all. And if I owned in this market, I would probably be doing the same thing. Let's go see what deliveries and absorption tell us. So we had 346 deliver in the first quarter, 319 absorb. Good, strong absorption. 87 deliver, 218 absorb. Again, good, strong absorption. 810 deliver, only 477 absorb. So now we're getting a tick down in occupancy, but we're still at 95.8, so not enough to start driving those rents down yet. Then we've got 436 deliveries, only 274 absorbed, so we got weak absorption 2 straight quarters. But again, we are still above 95%. So I do not blame this market for continuing to increase rents until this gets below that 95% mark. I'd even say I'd probably keep raising rents until it got below 93%. But that's just what I would do if I owned in this market. So cannot blame for what's going on here. So looking at this, because that occupancy is so high, I'm going to go out on a limb and say demand supply fundamentals are reacting appropriately because we haven't hit that inflection point yet. So that said, let's go take a look and see what each individual asset class is telling us. Here is our Class A rent analytic data. There are 39 properties, totaling 9,547 units. Looking at effective rent, we started 2022 at $11.94, went up to $12.82, up to $12.93, and up to $13.06. If we go take a look at our deliveries and absorption, you can see that we delivered 250 in the first quarter, delivered 173. A little weakness there, not too bad, but made up for it in the second quarter, where we had no deliveries and 154 absorbed. So 300 and what is that? 27 absorbed over 2 quarters, only 250 delivered. So good, strong absorption. Then we had 234 deliver and 76 absorb. So weak absorption there. And then we had negative absorption. So that's interesting. And we're down to that 93% number. You remember I said that owners will get to about 93% occupancy. That's when they really start to get worried and will start to lower those rents at that time. So moving forward, and we did see, even though I said we're going to discount that January information, we did see a lowering in the rents for the first month of the year, according to CoStar, which has been different than what we've been seeing. And it could have something to do if that is accurate. But again, I don't know if it is or not. That could be because of these 13 units that went vacant and the additional 234 minus that 76 that also went vacant. So no surprise there. I think we'll start to see the Class A market go down a little bit. So we're seeing a small crack, albeit right now this market's been holding its own and has been one of the strongest markets we've seen yet. But we're starting to see a crack in the Class A. Let's see if we can find a crack in the Class Bs. Here is our Class B rent analytic data. 258 properties in the market, totaling 20,064 units. Looking at effective rent, we were at 886. Wow, pretty low for a Class B property. We were at 886 in the first quarter, went up to 931, up to 953, and we had a break. Interesting. So we went down to 948. Didn't expect to see this, I got to be honest. So let's go see what deliveries and absorption tell us and why we see that break happening there. So we had 96 deliver in the first quarter, good, strong absorption, almost double absorption to 157. Then 87 deliver, good, strong absorption again, 73. I like to see it about 80%. That shows a stabilized market. Then 576 deliver, 393 absorb, getting a little weaker now. And then 436 deliver and 295 absorb. So absorption is slowing in the Class B space and occupancy is ticking down. But we're still above 95% occupancy. So a little strange that we saw the rents tick down for Class B properties. Kind of surprised to see that. In any case, other than that little tick down, I personally would have thought we'd have seen a little tick up in that fourth quarter, but it wasn't that big of a tick down to begin with. We're going to say that the Class B fundamentals are still there. Because we had that one slight little tick down, we'll have to see if that continues, but that may be showing a sign of a crack, but right now I'd call it more of a hairline fracture than a crack at this point. So kind of like the Class B market, especially with this really low vacancy, really high occupancy as it sits right now. So let's go see what the Class Cs are telling us. Here is our Class C rent analytic data. There are 315 properties in the market totaling to 10,269 units. Looking at effective rent, started the first part of 2022 at 693, went up to 712, up to 727, up to 737. Okay, so we've seen this a lot in the Southeast and in the Sun Belt. Does not surprise me in this market with the low occupancy, but let's see if, or the high occupancy, low vacancy, let's see if the Class C market is telling that same story. So we're not going to have any deliveries or construction, and we are seeing a little bit of negative absorption in the market, so these two cancel each other out. So, 19 more units went vacant than occupied in the year of 2022. But look at this occupancy, 97.8%. It can stand to have some more negative absorption. So that is zero surprise that we are seeing the rents continue to climb in the Class C market. This is one of the strongest Class C markets we have seen to date. Almost 50 markets into this research, and this is by far the strongest Class C market that we've seen. As a matter of fact, I'm going to go out on a limb and I'm going to say this is the strongest market we have seen so far. Even stronger than Fort Collins, Colorado, which had that number one spot from a week or two ago. So where does this place Northwest Arkansas on the market cycle chart? Well, we know we're above this long-term occupancy line, albeit we weren't very far above it. When we looked at it, 2 of the 3 asset classes were above that 95%, the Class C being the furthest above. We do know that we are seeing a slowing in absorption in all 3 asset classes. Because we have that slowing absorption, and we are still seeing rent increases, albeit small rent increases, I'm going to put the Northwest Arkansas metro statistical area right here in oversupply at this point. I would not be surprised if these numbers continue the way they're going, that it doesn't move back up to equilibrium. It's honestly, you would be hard-pressed to argue either one of these 2 points. I'm putting it here primarily because I'm scared to put it on equilibrium because we receive everything else. But I wouldn't argue with you if you put it on equilibrium. This is by far the strongest market we have seen yet. So applause, everybody, for Northwest Arkansas for maintaining that strength that they have. It shows that strong demand that the University of Arkansas and that Walmart, that number one employer in Northwest Arkansas, bring to that area. And of course, Walmart brings a whole lot of other industry with them in that area. So this may last a little while. It's definitely lagging the rest of the country in getting towards this recession phase. So once again, I'm going to applaud Northwest Arkansas and absolutely claim this to be the strongest market we've seen yet. So that concludes the video for Northwest Arkansas and concludes this week. So we ended the week with a bang. Next week, we're going to go to Wichita Falls, Texas on Monday, Bloomington, Illinois on Tuesday, Augusta, Georgia on Wednesday, Portland, Oregon on Thursday, and then we are going to skip a day. I've got an intensive that I'm doing next week where I'll be teaching an all-day training on how to find off-market opportunities. So on Friday, we will not be doing a video. All right. So those 4 markets, have a great weekend, and I will see you on Monday when we look at Wichita Falls, Texas.